Store had underperformed the REIT sector last year, which in and of itself is not that big of a deal, but there seems to be some management stuff going on there. The CFO stepped down in the middle of the year, and then in the last week of the year, the chairman and former CEO who we had on this show over the years and is someone who I always listened to his commentary and read all his stuff. He seems to have abruptly left his position. So I don't know anything that they haven't already said, but that was the guy for me. He was the founder. He was the architect of the business. So I think it'll be okay. But I need to make room to do some other things. So I took a profit. I went running out of that stock in the last week of the year, like Antonio Brown leaving the Meadowlands, ripped my shirt off, 80% or so gains from my average cost. I'm fine with it. I may revisit at some point in the future.
But the profits that you did take, and you mentioned, so you had some other capital to deploy. You bought the Carlyle Group, so you're making a private equity play here. CG, tell us why.
Yeah, so I think this is one of the crown jewels in the private equity industry. It's not the largest, but here's something interesting. These stocks all had a huge year last year for obvious reasons. They're very involved in all aspects of the economy, and the economy came roaring back. Carlyle is the only one of the larger publicly traded private equity names that does not have a dual share class. Not one of these companies, KKR, Blackstone, Apollo, Ares, Carlyle, not one is yet in the S&P 500. And I think that will change because these stocks like Tesla have just become too big to ignore. Now, the reason they weren't was the share structure. They weren't structured as corporations. That changed. The other thing the committee looks for is a year's worth of profits. A lot of these companies early in the pandemic had to take these on-paper write-downs because of where they had to mark assets. They weren't real losses, just on paper. We're now lapping that period of time, and I think all of these companies are eligible. Blackstone is gigantic, but still has that dual share class that the committee has historically not loved. Same thing with KKR. And that leaves Carlyle. It's a $20 billion market cap. It's a company that's seen massive growth in any metric you want to look at, from assets under management to cash flows, revenue, et cetera. And I feel that this has a lot of opportunity because while the three founders own about a third of the shares outstanding, a new CEO who's been with the company for a while but who is now running the show really has a lot of ground to make up to scale this business and catch it up with some of the giants. I think they can do it. You're getting paid almost 2% yield while you wait for that to happen. And I think when you think about alternatives and where investor dollars are flowing, it should be yet another good year for the whole sector.